All right. Well, welcome to week 13 of Finance 336 Derivatives. And this, our last lecture. I know everybody's heartbroken over that, but um, we're coming to the end of our derivative journey. So all I'm going to talk about today, I'm going to talk about the CBOE Volatility Index, or which is commonly referred to VIX, give you some insight into, uh, you know, how it's calculated, how it behaves. I definitely want you guys to be prepared to respond to questions about VIX price behavior versus the S&P 500. And then I'm going to talk about how the futures and the options, what the price behavior of those are, and what some common strategies are. VIX is a very unique animal, and it's not as straightforward. The futures contracts are not as straightforward as like S&P 500 futures contracts, where you can determine a fair value. It just doesn't work the same way. And same thing with the options contracts. The way they behave is very different as well. So the CBOE Volatility Index, or VIX, it's been around in a few iterations, but what has always been very consistent with respect to VIX is it is a 30-day measure of implied volatility. And if you remember, implied volatility is one of the pricing factors that goes into the to a Black-Scholes calculator, for instance, and helps us determine the price of an option. Well, you can take the market price of an option, and you can back into what implied volatility is being indicated by the price of that option contract. Well, what is done for the VIX calculation is a bunch of S&P 500 index options. In fact, basically all of the out of the money call options and out of the money put options that expire on the Friday just before and just after a 30-day time period. The midpoint of the bid-ask spread on those options is taken, and an implied volatility for each of those individual options is determined. And then, kind of like any index calculation, there's certain weightings that go into how much each of these options contributes to the VIX calculation. Uh, um, and it's a combination of how far out of the money the options are, but also how much time is left to expiration. And the time part is the part I really want you to think about for a second. And what we're doing is the VIX is basically being calculated by time weighting the options that expire just before 30 days, just after 30 days, and giving us a consistent 30-day measure. And again, they're based on the inputs into VIX are the S&P 500 index options. Now, the methodology really is considered an industry standard for how to put out an index that will give you a consistent measure of implied volatility. You can use the VIX methodology to come up with a 3-month outlook of volatility, a 6-month, a 12-month. In fact, there are versions of VIX that CBOE calculates and quotes that give you 3-month, 6-month, 12-month, and it's looking at them relative to each other is one of the uses that a lot of market watchers like to do. Myself, I like to look at the 3-month versus the 1-month. The 1-month is the VIX as we know it. The 3-month is uh, VIX 3M, I think, is the ticker now. It used to be VXV. And one thing that everybody really does know about VIX is that it moves in the opposite direction of the S&P 500. And because of that, you'll hear VIX referred to as the fear index. You'll also hear VIX referred to much more often when the stock market is coming under pressure. In 2020, VIX has gotten an awful lot of attention. Now, I like this 2016 chart just because it really does show several minor sell-offs in the S&P 500 and VIX reactions to those sell-offs. And you can see we had a nice sell-off here, and I believe this is related to Brexit. if I remember correctly. The original Brexit vote was in June of 2016. This one was actually just before the election of Donald Trump, not after. There was a breaking news story about a week before the election that threw the election and threw a lot of uncertainty into the election outcome, and VIX spiked up as well. So you can see quick moves up in VIX whenever we get even a minor sell-off in the S&P 500. And the reason that we get that sell-off, that we get these sorts of price reactions when the S&P 500 sells off, the reason that we get a spike up in VIX is because in the S&P 500 arena, more puts trade than calls on a regular basis. So the put trading activity tends to increase even more and is more aggressive on the buy side when we get some sort of sell-off in the S&P 500 or equity market weakness. And sorry, I had to take a drink. So what actually happens is is people start panicking. And when there's a little panicking going on, you want to protect profits, you look around for a way to go about doing that. Well, one of the best ways to go about hedging a portfolio is put options, and S&P 500 put options, SPX put options are probably I know for a fact that on a dollar basis in the US, they're the most actively traded option market out there. And the activity, right, if this blue line is right where I've got the red pointer right now, that means that twice as much put volume happened in SPX than call volume. This says VIX put volume. That should actually say SPX. That should say SPX. And you know what? I am going to fix that so that there's no confusion, but also so that it is saved. File, save, go me. All right. So higher SPX put volume versus higher SPX call volume. And VIX is driven by demand for SPX option contracts. The demand for SPX option contracts tends to really show up on the put side versus the call side, and that increased buying pressure pushes prices up, everything else being the same. When the option prices go up, the implied volatility is indicated by those option prices goes up as well. So VIX futures contracts, there are futures contracts that expire every month on VIX, and because of the way that VIX is calculated, you can't replicate VIX cannot replicate spot VIX in a portfolio. Since you can't replicate spot VIX in a portfolio, there's not a fair value relationship that shows up between spot VIX and the associated VIX futures contracts. And this will be cleared up a little bit with the next chart. Sometimes VIX futures are priced at a premium, and sometimes they're priced at a discount. What comes into play is a combination of sellers of VIX futures being compensated for the risk that VIX could move up very quickly. So in a low volatility environment, the futures are typically at a premium. If VIX has run up very quickly, and I'm going to go backwards for 1 second, but you can see VIX runs up very quickly and comes down, runs up, comes back down, runs up, comes back. There's a reversion to the mean process with VIX. Now, there are times that it goes up and it will run up to much higher levels, but a certain percentage of the time, if VIX is up strong over just a couple of days, it will be lower within a couple of weeks. And because of that knowledge, sometimes VIX futures will be priced at a discount because the VIX futures contracts, they take all of these other factors into play, but at expiration, the VIX futures and spot VIX basically the prices will replicate each other. So this is another kind of dated example, but I like this example an awful lot because we actually have 3 spikes in volatility. We could even maybe say 4. But going back here, this is late September, early October. The December VIX futures contract was trading at quite a discount as VIX moved higher. We see, spot VIX move up an awful lot. Well, the December VIX future did not move up very much at all. And that is because at this time point right here, there's 3 months until expiration. And over here at expiration, you can see that the as we get very close to expiration and we have another spike, the spot VIX and the VIX futures contract basically mirror each other's price action. So if you're thinking that we're going to have a really quick sell-off in the S&P 500 and you think about buying VIX futures contracts, you would want to buy the one that has the shortest time to expiration. That's the one that most closely replicates the price action with VIX. If you felt like back here, if you foresaw this spike in VIX, well, the near month at this time frame is probably the October contract, and it reacted a lot more relative to the spot VIX spike higher because there wasn't a whole lot of time for the October future to not expire yet or until expiration. So you can see that as we get closer to expiration, the spot VIX and the near month future, in this case the December future, in fact, here's the time frame that it was the front month future. As VIX was moving lower, the December VIX stayed at a little bit of a premium. We started to get moves higher. It went up, but there was already a little bit of a gap in here before we started to see the moves higher in the VIX futures contract and mirroring the spot VIX. This is typically how the pricing of VIX looks. This is one of the smoothest examples of VIX and the futures pricing, but it's also a time frame when VIX was down around 1150 or so. And this is February 17th. It's actually the day after February expiration. So there was about a month to March expiration, then another month. And you can see as we go farther out, there's a little, there's a consistent move higher. This is the typical, what we refer to as term structure for VIX futures pricing. So as you go farther out in time, when we're in a low VIX environment, we just tend to see a nice slope upward, and we refer to that as being in contango. Now, when VIX has a quick move to the upside and the futures are at a discount, we refer to that as being in backwardation. And backwardation can persist when VIX is at higher levels for an extended period of time. We were in backwardation for a good number of days in 2020. Same thing in 2008, 2009. But more often than not, probably about 80% of the time, VIX is in contango, and with the futures contracts trading at a little bit of a premium based on the possibility that we get a big move up in VIX at some point. Now, VIX options are cash settled and they share an expiration date with VIX futures. They are also European style contracts that cannot be exercised until expiration. So the options, they share an expiration date with the VIX future. They also share the price outlook of VIX, of where VIX is going to go with the VIX futures contracts. And because of that, VIX futures are the better underlying price for valuing VIX options. Although they both will eventually settle into a calculation of the spot VIX index. So this means, this is a key point and a very important point with respect to VIX option contracts, is you're better off pricing them off the futures, but keep in mind that they are going to settle into basically the spot VIX index. And the reason I keep saying basically, there's a slight difference to the settlement calculation for VIX futures and options relative to the normal calculation of VIX, but I don't want to dig too far into the weeds on that today. So this is another, I know I've got old examples in here, but these are just great. So on Friday, August 12th, VIX was at 1150 and the September VIX futures were at $15. Now, with spot VIX at 1150, and I'm using my color coding here, the 11 and 12 strike options would be very close to at the money option contracts. Well, look at this. You've got the 12 strike put trading at 20 cents. Well, if you can buy the 12 strike put for 20 cents, you have just you've just acquired the right to sell VIX at 1180. Remember, you cannot trade spot VIX. So if you could buy this put option for 20 cents and you could buy spot VIX for 1150, the net result would be you could lock in a 30-cent profit. The problem again is you cannot lock in this spot VIX price. What you can lock in is the VIX September VIX futures. And looking at the 15 line, we've got the call bid and ask at 155, 165, the put bid and ask at 160, 170. This is what you would expect to see for option pricing when the underlying market is very close to the strike price, or it's the at the money option contract. And that's what we've got right here with the September VIX futures at 15. These options are priced just like at the money option contracts. Now, again, if you think VIX is going to remain down at 1150, you could buy the 15 strike put for $1.70. And if over time VIX drifts down to the 1150 time, price point, and VIX doesn't move at all, that $1.70 would turn into, I think, $1.80 profit, if I'm doing the math right in my head. Yeah, that option would be worth $3.50, and you could benefit basically from the passage of time and the VIX future contract moving down to the spot VIX index price as expiration approaches. So I'm going to give you an example around this. So let's say, based on all that pricing that we just had, we think VIX is going to remain low, and we're thinking about buying a put option on VIX. Well, here's the offer price for the 12, 13, 14, 15, 16, and 17 put options on that date. And here's the break-even price for each of these. If you bought like the 17 strike put, which would increase in value as the underlying moves lower, you could pay $330 for it. As long as VIX is under 1370 at expiration, you'd make a profit. And if VIX stays down at 1150, you'd make a profit of $2.20. This is a way to trade if you think that, the VIX future is going to drift down to spot VIX. I'm just arbitrarily, there are all kinds of pros and cons here. This is really, the 12, you could pay 20 cents for that one. But I just kind of chose the middle one here as an example. You got the 14 strike put. You could pay $1.05 for it, and your break even is $12.95. And the profit or loss, if VIX doesn't move at all over the month-long period between the date that I priced this out and September expiration, you'd actually make $1.45, which is a decent profit off of a $1.05 for the to try and trade this. And this is what the payoff diagram looks like. And I think this really illustrates the point that I've been trying to get across. This is where the futures contract was, $15. And this is where spot VIX is. And this is the payoff diagram for being long the VIX September 14 put and paying $1.05 for it. And there's our break even at 12.95, and there's a really nice profit if VIX doesn't move at all. So this is a great way if you think VIX is going to remain low, spot VIX is going to remain low, and the futures are at a nice premium, that you can actually put a trade on to benefit from that. Now, what's difficult about VIX and what really gets people excited about VIX is trying to take advantage of those periodic spikes or be prepared for those periodic spikes. Well, in this case here, again, we had VIX at 1150 and the September future at 15 bucks. If we wanted to try to, if we felt like there was a catastrophe on the horizon and the stock market was going to sell off real hard and we were going to see a spike in VIX, well, if we wanted to try and play that, we might consider buying the September 17 call. The break even for that call is all the way up at 1825. And that means that spot VIX, if you intended on holding this to expiration, which if you get a spike in VIX, you tend to want to take profits on that spike, but we got to get a very large move in spot VIX. It needs to overcome this spread between itself and the September future, and then you have to hope that the September future is going to rally alongside spot VIX. And we've seen that when spot VIX rallies up, the futures contract tends not to follow to the same extent, especially if we've already got a big spread between the two like this. So getting long volatility with options requires some creativity. And let's say we want long exposure to VIX. We take a look at that thing, and the September VIX call, that's just way too expensive. We think if things rally up, maybe the future will get up to 20 or so. Well, one of the things we could do is we could buy a September 17 call again for $1.25 and sell the September 20 call at 80 cents. And this ends up costing us 45 cents. And this is what the payoff looks like. We've got before the payoff break even was here. We've moved the break even a little bit to the left, but we've still got to get a fairly decent move out of spot VIX, and the futures need to move along with it to hit that maximum potential profit of about what is that? This costs 45 cents, $2.55 right there. So the call spread is a really popular trade with VIX traders. It lowers the dollar cost. It limits some of the upside, but it does actually create an opportunity to benefit from a spike in volatility and not lose as much dollar-wise if that spike does not happen. Now, this trade is actually the most popular of the, and I'm going to do a correction here once again. 0. This case here, we've got, let me go to my laser pointer. All right. So we're going to sell the 13 put for 45 cents. We're going to sell the 20 call for 80 cents. Those together come to $1.25. Wow. No cost, but there is some risk here. No cost to this trade. So we're going to sell that 13 put and take in some income, and that's actually going to, have us set up at no cost to maybe benefit from a spike in VIX, but we do have some downside risk in this case. And what we actually have is we have a potential loss if VIX remains at 1150. But even if we just get a moderate move higher in spot VIX, we tend to, at least in this case, if VIX is between 13 and 17, we have no loss or no gain. And then above 17, we start to benefit from the upside move up to 3 points, up to 20. Now, the thing is, when you see trades in the option market, they are very rarely done in a vacuum, which means they tend to be combined with other positions. And typically, if you're trying to set up for a big move in VIX to the upside, you're setting that trade up because you're concerned that the S&P 500 may sell off. And if the S&P 500 sells off, then you would lose money on your stock portfolio, but you would make some of it up with the VIX position that you have on. Basically a hedge. It's not a perfect hedge because there are lots of other factors that can come into play with how well the VIX portion of the trade or the VIX portion of your portfolio works out. But this is one thing to keep in mind. If you put this trade on and VIX is at 1150 and it remains at really low levels, that probably is because the S&P 500 has continued to perform well. VIX remains at low levels when we're in a nice bullish move to the upside in the S&P 500. So if you were to put this trade on, and we didn't get a spike in VIX over the month-long time frame that it covers, which would be accompanied by a sell-off in the S&P 500, at minimum, you're probably making some of, if not, you're basically going to cover the losses that are associated with this trade. And when you put on hedging transactions, if the hedge ends up not working out in your favor, that just means that the thing that you were hedging did not lose value. And if the thing that you're hedging did not lose value, you're making money in the other market to offset the loss in a trade like this. But we do see an awful lot of selling a put to buy a call spread in the VIX market. So with that, just some very high level information on VIX futures, taking a look at how VIX options are used if you have a short outlook and a long outlook. And with that, I'm going to hit end of recording, and I will see you guys at our next Monday, Wednesday, or Friday class period.